Question: how can you sell a stock you never owned? And the person you borrowed it from might never even notice it's gone. It sounds impossible, maybe even illegal, but it happens trillions of dollars worth of times a year. Let's strip down how short selling actually works. It is far simpler and far more mechanical than it sounds once you see the plumbing. Here's the core move. You believe a stock's price is going to fall, so you borrow a share from a long-term holder through your broker. You immediately sell that borrowed share on the open market today at today's price. The cash from the sale lands in your account. Your plan is to wait for the price to drop, buy the same share back for less money, and then return the share to the lender. The difference in price is your profit. That is a short sale. The odd part is what the lender sees. Their account statement still shows they own the stock. They still get the economic exposure. Their account value rises and falls with the price. The only thing they typically lose while the share is on loan is the right to vote at shareholder meetings, unless they recall the share in time. From their perspective, almost nothing has changed. Why it matters is the promise you make. A short sale creates a future, mandatory buyer. That buyer is you. Every open short position is a timer that will one day add demand to the market when the position is closed. That promise is why a crowd of short sellers can turn into rocket fuel for a stock they are betting against. Before the modern rules, the system had a ghost problem. It was called the fail to deliver. A seller would promise to deliver a share and then just wouldn't. For days, weeks, even longer. If this happened on a massive scale, you could have buyers who paid for shares that didn't seem to exist, and sellers who sold stock they never managed to borrow. These phantom shares could depress prices and gum up the entire works of the market. It was a system running on IOUs that were never cashed in. That is the world that regulators decided they had to fix. Let's walk through the life of a modern short sale. First comes the locate. Before you can hit the sell button, your broker must have a reasonable belief they can find a real share for you to borrow. They don't have to borrow it yet, but they have to know where one is. No locate, no legal short. This isn't a suggestion, it is the rule, a direct response to those phantom shares of the past. Once the locate is confirmed, you borrow the share. Then you sell it into the market. Cash lands in your account. It feels like profit, but it is not. That cash is locked. The broker holds it as collateral because you still owe a very expensive thing back, the share itself. What do you owe from that moment forward? You owe the lender an identical share back, someday. You owe your broker borrow fees, like rent, for every day the position is open. And you owe the lender any dividends the company pays out while you're short. Your meter is running, and the costs are adding up. That locate rule is part of a package called Regulation SHO, which the SEC put into effect in 2005. It was a major overhaul of the plumbing. It forced brokers to have a locate before shorting, and it created new requirements to clean up chronic failures to deliver. In plain words, it told the market, do not sell what you cannot hand over on time. Reg SHO also created a watch list for trouble. If a stock piles up a significant number of failed deliveries for 5 straight days, it lands on a, quote, threshold list. This is a public signal that something is wrong with the supply of shares. Once a stock is on that list, the rules force mandatory buy-ins of failed positions much faster. The point is simple. Deliver what you sell. Now, the cushion. Shorting requires a serious cash buffer. In the United States, regulations typically require you to have 150% of the short sales value in your account when you open the trade. That's the 100% in cash from the sale itself, which is locked, plus another 50% of your own money. And that's just the minimum. Brokers often ask for more, especially when a stock gets volatile. After you open the short, the bar moves. You must maintain a certain level of equity in your account, known as maintenance margin. A common floor is 30% of the short's current market value. If the stock price rises, the value of what you owe goes up, and your equity cushion shrinks. If it shrinks too much, you get the dreaded margin call. Deposit more cash, or we will close your position for you. A painful truth sits under every short sale. Losses are theoretically infinite. When you buy a stock, the most you can lose is what you paid for it, if the price goes to zero. But a stock you shorted can, in theory, rise forever. Your broker knows this. That is why they watch your cushions so closely. If it gets thin, they will not hesitate to close you out to protect themselves. Then there is the rent. Borrow fees are the interest you pay to use the share. For huge liquid stocks, the cost can be near zero. But for stocks that are in high demand from other short sellers, or where there's little supply to lend, the cost can explode. In wild situations, the annualized rate can jump into double or even triple digits. It is a cost that drains you day by day. GameStop in 2021 was a masterclass in this rent spike. As shorts piled in and supply dried up, borrow costs surged into punishing territory. At some points, just holding a short position for a week could cost a fortune, even if the stock price went nowhere. That is the carry cost. When you are short, time is actively working against you. Dividends bring another bill. If the company pays a cash dividend while you are short, you must pay the lender an equivalent amount out of your own pocket. This is called a payment in lieu of dividends. It ensures the lender is made whole. It looks and feels like a dividend, but for tax purposes it often is not, which can create a less favorable tax outcome depending on your jurisdiction. So who owns this vast library of lendable shares? The biggest players are the quiet giants of finance. Think pension funds, life insurers, and especially the massive index funds that now hold a huge slice of the market. They hold stock for the long term, and letting it sit on the shelf is an opportunity cost. So their custodians and prime brokers run sophisticated lending programs. It's a lucrative side business. They take high-quality collateral, often cash worth slightly more than the stock, and then earn a fee on the loan. Even better, they can often reinvest that cash collateral for a short-term profit. It's a low-risk way to squeeze a few extra basis points of return out of a massive portfolio. For them, your short sale is their steady income. Here is a small surprise. Your own shares can be lent out while you sleep. If you hold stocks in a standard margin account, the fine print in your brokerage agreement likely gives your broker the right to lend them out. If you own a mutual fund or ETF, the fund itself probably has a lending program. You will still see the shares in your account, but someone else might be borrowing them to sell them short. Now for the spooky headline you may have seen. How can short interest, the number of shares sold short, go over 100% of the company's available shares? Is that proof of illegal activity? Not necessarily. It can happen because of how the plumbing works. Remember, a short sale creates a new long on the other side. The person who bought the shorted share is now a legitimate shareholder. Their broker can now lend that share out again. That second loan can be used for another short sale, which creates yet another new long holder. Chain that a few times, and the official short interest figure can mathematically add up to more than 100% of the shares available to trade. It is a function of velocity, and it's a perfect setup for a squeeze. At the center of this web sits the prime broker. These are the specialized banks that service hedge funds. For a short seller, the prime broker is everything. They are your source, finding the shares to borrow. They are your bank, managing the complex collateral and margin. And they are your risk manager. They watch your positions like a hawk, because if you blow up, they could be on the hook. And when a lender wants their stock back, it's the prime broker who delivers the bad news. If they can't find a replacement share, they are the ones who will pull the plug and force you to buy right now at any price. What can we see from the outside? Not much in real time. In the U.S., exchanges publish official short interest data just twice a month, and it is reported on a lag. By the time you read it, the data is already a week or more old. It's a useful snapshot, but you are always looking in the rearview mirror. One ratio helps size up the risk: days to cover. You take the total short interest and divide it by the stock's average daily trading volume. This gives you a rough estimate of how many days it might take for all the shorts to buy back their shares. A high number suggests the exits are narrow. If everyone rushes for the door at once, it will get crowded fast. There is also a speed bump designed to stop a stock from going into free fall. For nearly 70 years, the market had an uptick rule, born from the ashes of the Great Crash. It said you could only short a stock when its price was ticking up. It was a brake pedal. But in 2007, regulators removed it, arguing it was an old rule that impeded efficient markets. The debate was fierce. Critics warned that removing the brake would accelerate crashes, and when the financial crisis hit the next year, the chorus of "I told you so" was deafening. So in 2010, a new, modified rule came back. That newer curb is called the Alternative Uptick Rule. Once a stock drops more than 10% in a single day, this restriction kicks in for the rest of that day and the entire next trading day. It does not ban shorting, but it says you can only short the stock at a price above the current best bid. It forces short sellers to be price takers, not price setters, slowing down a downward spiral. Now for the biggest risk of all, recall risk. The original lender can ask for their shares back at any time, for any reason. If that happens, your prime broker has to find a replacement share for you to borrow. If they cannot, you are bought in. That means the broker goes into the market and buys the shares to return them on your behalf at whatever the current price is. No debate, no waiting for a better price. A single recall can break a whole chain of relending. That can trigger a cascade of forced buy-ins across multiple trading desks. This is forced demand. The stock price can rocket upward not because anyone's opinion about the company changed, but simply because the plumbing of the market seized up. This brings us to a legendary squeeze. Volkswagen in 2008. Porsche had quietly built up a massive position, not just in shares, but in cash-settled call options. This was a key detail. Many shorts thought those options wouldn't drain the physical supply of shares. They were wrong. When Porsche revealed its hand, and you added in the shares owned by the state of Lower Saxony, the market realized that almost the entire company was locked up. The real free float available to trade was tiny. The scramble to buy back shares was brutal. On October 28, 2008, Volkswagen stock spiked to €999 a share. For a brief moment, it became the most valuable company in the world by market cap. Not because its business prospects suddenly changed, but because the supply of borrowable shares had vanished overnight. Then there was GameStop in 2021. Reported short interest was over 100% of the float. Borrow costs jumped. At the same time, retail traders famously piled into call options. This had a hidden explosive effect. The market makers who sold those options had to hedge their own risk. And how do you do that? By buying the underlying stock. Every call option bought forced dealers to buy more shares, adding jet fuel to a fire that was already burning hot. On January 28th, the price hit an intraday high of $483. Some lenders recalled their shares. Borrow became scarce and insanely expensive. Shorts were hit with margin calls. Many had to buy back at the worst possible prices just to get flat. This created a feedback loop. A higher price caused more pain, which caused more forced buying, which pushed the price even higher. When things get this wild, sometimes the referee steps in. During the 2008 crisis, the SEC temporarily banned short selling in hundreds of financial stocks. Other countries did the same. In a more unusual move in 2019, Germany's regulator banned shorting in one single stock. That stock was Wirecard. So, did the bans work? Most academic studies that looked at the data afterwards found they didn't really prop up prices for long. What they did do was reduce liquidity and widen the gap between bid and ask prices. In other words, banning shorts made it harder and more expensive for everyone to trade. They often soothe political feelings more than they fix market plumbing. So why allow shorting at all? Because they are a crucial part of price discovery. Short sellers have an incentive to dig for bad news, to uncover frauds and flawed business models. Remember Wirecard? It collapsed in a massive fraud in 2020 after admitting nearly €2 billion were missing. Short sellers had been raising alarms about its accounting for years. It is a messy, adversarial process, but it can surface the truth. The politics are unavoidable, though. In a panic, short sellers are an easy villain. It is much simpler for executives and politicians to blame the messenger than to address the message in their falling stock price. When pressure builds, rules and bans tend to follow popular sentiment. That is why the debate over short selling never truly ends. There is also the slow grind that kills many short positions. Even if your thesis is right, the cost of carry can bleed you dry. Borrowing fees, dividend payments, and the constant stress of margin calls eat away at your capital and your resolve. A company can also fight back. By buying back its own stock, it can shrink the float and mechanically push up the price against you. If you are finding this breakdown of market plumbing useful, take a moment to subscribe. We explain the mechanics of how markets really work without the hype or the buy or sell noise. It is all about understanding the machine. This brings us to the general rule. Prices move on opinions, but they are driven by obligations. A long holder can afford to be patient. They can sit on their hands, ignore the noise, and wait. A short seller cannot. They are obligated to act when their collateral runs low, when a recall notice hits their desk, or when new rules switch on. They have a clock, and it is always ticking. In a true short squeeze, the mechanics dictate the price first. The narrative, the story of why the stock is moving, catches up later. That is why some price spikes look completely insane in the moment. You are not watching a debate about a company's future. You are watching the market trying to clear a huge pile of promises with far too little supply. So when you hear that a stock is heavily shorted, think beyond the simple bull versus bear story. Think about the clock. Think about borrow costs, margin levels, recall risk, and the days to cover. Those are the hidden levers. When they get pulled, price can move for reasons that have nothing to do with new facts about the business. The trade is simple to explain, but hard to live. You sell what you do not own, and you always owe what you sold. The owing part is what drives all the drama. That is how short selling really works. It is not dark magic. It is contracts, collateral, and clocks. Once you see the pipes, bubbles and crashes look less random and more human. If you like clear market mechanics with no hype, subscribe and poke around the channel. There is more on bank runs, crashes, squeezes, and how incentives bend prices. Drop a like if this helped, and share it with a friend who wonders how stocks can spike. See you in the next one.